All right, good evening, traders. A very warm welcome. I am Devang Mehra from the Financial Analyst, and welcome to the Bold Project. In this module, I'll be discussing over different order types available in the market. So there are a couple of different order types. So make sure you watch this video till the end so that you'll have ease of trading when it comes to the financial markets. So personally, I'll tell you what I have done. I have a couple of brokers lined up. So if I'm trading the future and option segment, I have a different broker. If I'm trading equity, I have a different broker, and for commodities, I have a different broker. So I have done my segregation. Why I do this is because I want to keep a different, I want to keep a segregated portfolio for all the three different types of investments. At the same time, all the different type of investments are taxed differently in India. That's my home country. For example, the intraday trading, future and options comes under income from business and a profession, whereas your long-term investments they come under capital gains. So I basically want to keep a track of all my investments. Personally, what I've done is ICICI Bank, which is basically my own bank. I have a demat account with them, so that's ICICI Securities, and they basically handle my long-term investments. So if I have to do any swing trading, if I have to do long-term investments, I do it with ICICI. And if I want to do future and options, if I want to do derivatives, I basically have Zerodha, which handles the future option trades that I take, whether it's intraday or overnight. At the same time, any equity intraday is also handled in Zerodha. And the reason is because they charge the least brokerage, and I find it very user friendly and comfortable. So whatever suits you, whether you use Upstocks, Angel, Sharekhan, whatever you are using, that's totally fine. The all the brokers are good. It's about your own personal preference, who you like in the market. And also for commodities, I have a different broker, which is Enrich. It's a South Indian company. So I'm really comfortable with this setup. You can try to do what you're more comfortable with. So let me head over to the Zerodha website. And when you log into their website of Kite, this is something of how things will be opening up in front of your screen. So you can do two things. You can do buy or you can sell. So we'll cover everything in detail. And I hope throughout this journey, you will understand how we execute the orders. Let's look at a very simple example. Let's go to the Reliance option. If you have to search any stock, just click on the search icon. You can search the ticker of the stock and that stock will come in your watch list. The site is very self-explanatory. If you still have any doubts about the website, you can give us a call or you can attend our weekend webinars. So let's say I want to trade in Reliance. So I want to buy Reliance. Let's click on the buy icon. Throughout this example that I'll be giving you, I will be assuming I have a capital of 10,000. That's an assumption I would like to make. So the entire examples will become very clear to you. So when you click on buy Reliance, this screen will be opening up in front of you. So first let's start with regular because I have done some settings. So when you open that, when you click on that buy, this screen will be opening up. You will be triggered at the regular option. So then it will ask you, what do you want to do? Do you want to buy Reliance on the intraday basis? That is the MIS, which I discussed with you in the last module. Or do you want to do long term, which is CNC? CNC means cash and carry. Intraday means MIS, margin intraday square off. I think you already know the difference. Just to quickly sum it up, see when you click on CNC, it means that you should have that cash to buy that stock and hold it overnight. So when you are buying a stock in long term, you are accepting delivery of the stock into your demat account and you can hold the stock as long as you want. But if you are buying the stock in intraday, it's basically like you are taking a loan from your broker and you have to pay him back. So you do not take a delivery of the stock. The broker has the stock. You take the stock from your broker, you give him some kind of a token money called margin. And then when you return the stock, he gives you back the profit or loss, whatever it is. We will discuss about this in the examples. First, let's talk about the long term or the CNC. So when I say long term, it means any trade done more than one day. So if you are trading within the day, then it's intraday. But if you are trading more than one day, whether you buy today, sell tomorrow, the BTST orders, if you hold swing trading, or if you are holding for months or years, you will be clicking on long term. So once you click on long term, it is going to ask you what is the quantity that you want. Number one, that's the first option that we have. So I said I have a capital of 10,000. So how much can I buy Reliance? I can only buy Reliance 5 shares. You can see on the bottom of the screen, the margin required tab will come. So this will exactly calculate 1993 is the share of Reliance right now, multiplied by 5 is 9966. If I click on 10 shares, this will calculate up to 19,930. And if I still click on the buy icon, my order will be rejected. Why? Because of lack of funds. I only have 10K in my account. Let's again go back to the example of 5 quantities. So I have 5 quantities. I can only afford 5 quantities of Reliance. So now what do? Then the Zerodha platform will ask you, what kind of order do you want? Do you want a market order or do you want a limit order? Let's start with the market order. When you click on the market order, this means that you are buying 5 quantities of Reliance at the market price. This basically means whatever price is prevailing in the stock exchange, that price will be given to you. So I generally do that. I generally go for a market order. But if, let's say, markets are very volatile, if they are moving up and down a lot, so if you then click on market order and buy, maybe whatever price you are getting on the screen right now might not be allotted to you because there is such high swings. So it's possible you might miss out on a potential move in the market. So I will teach you what is limit. Market basically again means you are buying at the market price. Whatever price is there, when you click buy, whatever price is there, that order will be get executing at that price. Limit order basically means that you are buying at a preferred price. So for example, the current market price is 1993. I go on limit and I click on 1990. What does this mean? This means that if Reliance comes to 1990, my order will be executed. Otherwise, it will get cancelled by the end of the day. If I click on buy, it will go to pending status. Whereas if I click in the market option and go on buy, it will go to completed status. Because market may, there is no limit. Whatever is the price, it's you getting that price. If you go to limit and click on buy, it is going to go to pending option. So if that price comes, then your order becomes completed and then it will go to positions. Otherwise, it will stay in the order stack. I hope that point is also clear. So I can put the price of 1990. If this price comes good, if this price doesn't come, too bad. The order gets cancelled by the end of the day. Also, you can do something called the GTT order. This is something that Zerodha is doing. Since I don't do my investments from Zerodha, I'm very comfortable with ICICI, but I'll just give you a hint of what GTT is. Basically, GTT helps you to, so for example, I am very active in the market. So I do not set this order. So for some people who are not very active in the markets and who want to forget about a purchase that they have done, they can go for a GTT. So when I click on GTT, this will basically help you to put a stop loss and put a target price. And when they are triggered, it is automatically sold. So what is target price? Target price basically means what is the level that you want to achieve. If you buy Reliance at 1990, I'm buying at the market, which is 1993. So what is the target that you are looking for? That's called the target price. What's the potential move that you're looking for? What is stop loss? I have discussed in detail over the course, but just to get you started, stop loss means that place where your trade idea gets invalidated. For example, you bought Reliance at 1990, you are expecting price will go higher. So currently we are buying Reliance. So if I buy Reliance at 1993 and Reliance goes higher, I will make that much money into five quantities. What is stop loss? Let's assume I buy at 1993 and some news comes into the market and the share price falls. If I don't have a stop loss, I will be bearing huge loss because share price is tumbling. They are going against me and I will make that much loss. But if I have set a stop loss, let's say at 1980, 10 rupees below the current market price, that will mean that if the share price from 1990 falls to 1980, my order will automatically get sold there. So I will automatically bear that 10 rupee loss into 5, that is 50 rupees loss. Automatically my order will get sold. So if Reliance crashes below that, I am not concerned because my orders are done. I hope things are making sense. So with the GTT order, you can set a stop loss and you can set a trigger price. Sorry, a target price. So currently you can see on the screen, it says -5 stop loss and 5 is the target percentage. So for example, if I buy Reliance right now on the CNC, which is for the long-term purposes, if Reliance goes up 5%, automatically order gets sold. If Reliance falls below 5%, automatically order gets sold. So this is something that you can also do on your chart. So this is basically my long-term option. In your long-term, I can't sell. I can only buy. Basically, you can't make money by the stock going down. You can only make money by buying low and selling high. Now let's look at the intraday option. What is intraday trading? I've already made this very clear. You buy at any time during the day, but you have to compulsorily square off that position, book that position, whether it's a profit, whether it's a loss, by 3:30. That's the maximum time you get. I just want to give you a heads up if you're trading on these discount brokers or any of the platforms with any of the brokers. I don't suggest you to hold till 3:30. Try to exit your positions by 3 o'clock or maximum 3:15. The reason is because let's say you are suffering a loss and you are disheartened and you leave it for the system to get squared off. Markets, the broker, it will charge you a squaring of fee, a squaring of commission. It's like a penalty because you are not doing it, that person is doing it for you. So he charges, I think, about 50 rupees or 100 rupees. I don't know what the exact amount is right now. So I will always suggest, no matter what, try to square off your trades by 3 o'clock or 3:15, and don't take any fresh trade after 3 o'clock. Doesn't make sense because you don't have too much time. After 3 o'clock, as I said, it's for BTSTs. BTST, you do it from long term only. You don't do intraday. So when I click on intraday, what's the difference? Squaring off, you understood. At the same time, brokers give you what? Margin. Because you are not taking delivery of the stock. You are coming to the broker. You are basically taking the stocks on a loan from him and then giving it back. So just see how the margins change. Currently, to buy long term, it takes 9966 rupees. If I go to intraday for buying 5 shares, it only takes 1000 rupees. That's the beauty of intraday. I hope now I have answered why people do intraday. It's not because I have a time limit, but actually because I can trade huge quantities of shares with limited capital. So if you are a student, if you have only 10,000 rupees in your pocket, it doesn't make sense for you to go to long term because your entire capital will be exhausted and you can't do anything else. Whereas that same amount of money you can spend in intraday and that trade will be executed at 1/10 the amount. So you actually save a lot of money. So your broker gives you margin. How much percent is that margin? That depends upon the market volatility. It keeps on changing. So if markets are extremely volatile, the broker might not give you too much margin. In the normal situation, they give you about 5 to 10% margin. So whatever is your capital, you can trade about 5 to 10 times of that. Depends upon the situation. So currently with that 10,000 capital, now I can purchase not 5, about 50 shares. You can see now I have got a 10 times margin from Zerodha at the current market conditions. Things are okay. So Zerodha is telling me you have a capital of 10,000, trade with 1 lakh rupees. It's giving me that 10,000 capital. So this is the beauty of intraday trading. Obviously, if you're earning more profits, you will also earn more losses. Why? Because if things go wrong, now your loss will get multiplied by 50 rupees. Earlier in long term, it was getting multiplied by 5 rupees, 5 quantities. Now it will get multiplied by 50 quantities. So don't think intraday is an easy game. If you earn big profits because of intraday, you will also earn big losses if things go against you. That is why we keep a stop loss in the market. So let me explain the intraday orders. The orders are almost the same. The only difference was that you got more margin. So one order is market. So if you want to buy Reliance, if you think Reliance will go up to, if you it will go higher in the next 5-6 hours, you can buy Reliance on market. Market basically means that same price, whatever is prevailing in the index, will be allotted to you. So immediately when you click on buy, it will go to your positions. And if you have to exit, you can go to position and press exit. It will get exited. Limit is again a very simple thing. You want to set your own price. I click on 1990. So rather than buying 50 quantities at 1993, the broker will buy 50 quantities at 1990 price. Now there are 1 or 2 more orders available on the intraday tab. This was the regular option. I can make some more complex decisions. So let me show you what those complex decisions are. Now see the change that I do. Currently, when I do a regular intraday trade, it takes about 10,000 rupees for 50 shares. If I click on this tab of cover order, see how this figure changes. If I click on the tab, now for 50 quantity, I require only 6,000. So can you see now the broker is not giving me 10 times. It is giving me around 13 to 14 times margin. So with a 10,000 capital, I am actually trading worth around 1,40,000 rupees. That is the power of intraday. So if you know a move is coming, come to intraday, make your profits and get out of the trade. As simple as that. So what is cover order? In the regular order, was I setting any stop loss? No, I was setting my price and I was trading. In the cover order, cover basically means if you are entering at a price, you are covering yourself. It is a mandatory stop loss order. As simple as that. Cover order, I would say, is a disciplined, more disciplined way of coming into the markets. That's the best way I can put it. So if you enter a price, let's say I go on a market cover order. So this means I'm buying 50 quantities. I can actually buy more now. I can now buy 80 quantities. Why? I have a capital of 10,000. I can buy 80 quantities now. That's the power of intraday trading. So when I say cover order, I can do market. So now in market, yes, I get more quantities. It will ask me a trigger price. This means stop loss. So for example, I click on 1980. What does this mean now? Cover order is, it's a mandatory stop loss order. If you are buying at a particular price, you have to set a stop loss. So that is the reason. Why does your broker give you more money? That's a question people might be asking you. In the regular, you are only getting that 50 quantities. Why are you getting more quantities in the cover order? It's very simple. The broker doesn't know who you are. You might be the president of India. The broker doesn't care. As simple as that. No disrespect, but the broker is concerned only about his money. So if you come to the regular tab, you are not setting a stop loss. So let's say Reliance crashes. Your broker is going to bear the loss. If let's say, because the maximum loss that you can bear is about 16,000. That's the maximum loss. But if the share crashes even below that, your broker is going to bear that loss. If I go to cover order, I'm actually setting a limit. I'm setting my loss can be stopped at 1980 or it can be stopped at 1970. I'm setting a mandatory stop loss. That way your broker knows that even if the shares crash, your loss is limited. That is giving a sense of peace to your broker. And that is why broker gives you more money to play with. So I personally would suggest go for a cover order. That's something I personally do when I enter intraday trade. It's very, very comfortable. So when I say trigger price, that means stop loss. So whenever you buy on market, select a stop loss. So if you're buying, the stop loss will come below the order because things you are expecting to go higher. If it goes down, that will be a loss. You can also go on the limit order. Limit basically means you're selecting a price. So 1990. So this means that if Reliance comes to 1990, you will buy 80 shares with a stop loss of 1970. This is basically the cover order. You have another order called the bracket order. Again, very, very simple. Cover basically means you're covering from one side. Bracket means covering from both sides. What does it mean? The margin is the same now. Cover is the maximum margin that you can get. So in bracket order, what are you doing? It's only a limit order. It doesn't mean market. It's only a limit order. So when I say bracket order, I'm buying 80 shares of Reliance at what price? 1990. What is the stop loss and what is the target? That is what you have to set. You have to set this in absolute terms. So for example, I'll click on 10 and 20. What does this mean? That 10 rupee stop loss, 20 rupee target. That is what it means. So if you are at 1990 and if the share goes to 1980, 10 rupee below, your order will be exiting at a loss automatically. And if the share goes to, if the share goes to 2010, 20 rupees higher than the current price, automatically target is achieved. So order will be squared off. Do I make sense? Think about it for a minute. Just to reiterate, stop loss, you are buying the security. So when you are buying, you are expecting price to go higher. If the price goes lower, that's a loss. So the stop loss on the buying side will always be lower. So when I say 10, you can select 20, 40 also. That's totally up to you. This will mean 20 rupees below a stop loss. So 1970 stop loss and 2030 is target. So when I place bracket, this is actually very comfortable for people who go to office. They want to place a trade and forget about it. So they can place this trade and forget about the trade. They don't have to track the trade. This way, automatically when anything is achieved, things are getting squared off. So you don't have to constantly look at the screen and trade. I'll again give the normal example of 20 is the target and 10 rupee minus is the stop loss. What is this concept of trailing stop loss? That's also very important. Trailing stop loss basically means coming ahead videos, you will understand exactly what it is. So I will explain this in much more detail in my webinars on the weekends and in the videos to come by. But just to give you an example, you are buying the share at 1990. What if the share goes to 2050? What if the share from 1990 goes to 2050? Do you think now that 10 rupees stop loss, your stop loss was what? Your stop loss was 1980, right? So do you think now from 2050, price can come to 1980? It can't come. It's very unlikely. So what you can do is you can trail the stop loss. So rather than just having a naked position, The problem with the naked position is that maybe if you don't have a stop loss and things crash, you might go into a loss. With trailing stop loss, what happens is if I click, let's say 2 here, what will this mean? This will mean if 1990 is the price, correct? I bought at. If the price goes to 1992, 2 rupees ahead, my stop loss will also go from 1980 to 1982. If I click on, let's say 5, this will mean if my price goes from 1990 to 1995, my stop loss will also go from 1980 to 1985. So I'm bringing forward. So as I keep on going higher on the price, my stop loss also keeps on coming higher. Eventually, it helps me to make much more disciplined trades. This concept you will understand much more in the videos to come by in the chapter of risk reward, stop loss, and target. This is about your buying side. Yes, you can also do a sell order. The sell order will only be possible where on the intraday basis. On the long-term side, you can only buy and make money. In the intraday side, if you think something is going to crash, you can sell the security. You don't have to buy, just sell the security here and you can then buy it later. It's as simple as that. So again, all the orders are same. Regular order, what does it mean? It means that you are selling how much quantity? That was 50 quantities, if you all remember. I can sell 50 quantities of Reliance at what price? Market will mean the current market price. Limit will mean what price. So for example, 1995. If Reliance comes to 1995, then my sell order is executed. When will I make money in shorting? If from 1995 things go down, 1990, 1980, then I will make money. If 1995 it goes higher to 2000, then I will lose money. Why? Because currently I'm shorting in the market. You can also do something called cover order. It's exactly the same. You will get much more margin. So now you can trade with 80 quantities. And now what's the mark? So let's say I'm going to place a market cover order. So I am selling at 1993. Can you think about what the stop loss will be now? Will it be down or will it be above? Think about it. When will you make money in the market? You will make money in the market if price from 1993 goes down because you're betting on the downside. You're shorting a stock without actually buying the stock. So if you are betting on the downside, the stop loss will come on the upside, 2000. As simple as that. And finally, we can have the bracket order, which is exactly the same. You can set a limit price, let's say 1995. Your stop loss can become 10 rupees, targets can become 20 rupees. So target is 1975, stop loss is 2005 because you're shorting the stock. One last order that is there is called AMO. AMO basically is for buying or selling. You can do both. For example, let's go to TCS. What does AMO mean? AMO is something personally I don't do, and I don't think any traders do AMO now. But AMO means an aftermarket order. So, for example, you want to trade at 4 o'clock in the afternoon, 7 o'clock in the afternoon. So after 3:45, I think in India, the AMO start, and I think they are valid till 8:45 a.m. the next day. Basically, the markets in India, the pre-markets open at 9. So around 8:45, the AMOs are active. I don't know if the numbers are right now, but I'll have to check. The idea of the AMO is to place an order after the market. So for example, you get a news at 5 p.m. in the evening, Google taking over Reliance. Google buying a stake in Reliance. So you know for sure the price of Reliance is going to go higher. What you can do is buy Reliance right now. So for example, right now it's 10:55. I can place a buy order and just be done with it. When will this be executed? This will be executed tomorrow when the market opens. Whatever price the market opens, I will get my trade. I don't suggest this because we don't trade on news. We should always wait for the price to open and then trade on it. Let's not think that a news comes, things go higher. Let's wait for the market to open, see how markets react, and then accordingly you will trade on that news. AMOs are helpful for one order. Just to conclude this entire session, AMOs are very helpful for buying circuit stocks. So for example, stocks like Adani Green. If you traded, you already know. Adani Green is one stock that was stuck in circuit. If you see this period, it was stuck in circuits for quite some time. What do you mean by circuits? Basically, SEBI has mandated that companies have a limit. So, for example, for Adani Green, if the shares go higher 5% or shares go lower 5%, they will be stuck. They will be the trading will stop it will halt in the shares. Why is that? Because if the circuit is not there, things can really go bad. For example, during the coronavirus time, markets in India, the Nifty markets did halt. If you all remember that day, because of that circuit. If the circuit was not there, imagine markets going down 15, 20, 30%. That can happen because of the panic. So just to control this emotion, we have the circuit concept. Every stock has a different circuit. You can check the NSE website. So Adani has a circuit of 5%. So imagine every day when you open the market, 9:15, there is a circuit. Tomorrow, circuit. So you can't trade because things are locked in a circuit. You are not able to trade in Adani Green. So you are to get a better luck, you can place an AMO. This will help you to be favorably placed ahead of the competition. If there are 10,000 people involved who want to buy Adani Green, no one is getting it because the share is in a circuit. No one wants to sell, everyone wants to buy. So if you place an AMO, you get some preference when the orders get executed. So that's it for now, guys. I hope you understood the video. Let me know if you have any doubts.